simple strategy to successful investments.
Hey everyone, my name is Ryan.
And my name's Travis.
And welcome to our channel. We're going to be talking today a little bit about some investment strategies and just what we personally do and what's worked. And then we've also read a book by Grant Sabatier, Financial Freedom, something we've been paging through a little bit lately. So I just want to share some of the stuff that he has to say and think it'll be good for you guys too.
So getting into the first strategy, keeping it simple, is minimizing risk. And kind of sounds obvious, like, hey, let's not make dumb decisions, or hey, let's invest wisely. Yeah. But it's really focusing on finding worthwhile things to put your money into. Bitcoin is fun and is exciting, but it may be something to get into when you have more secure investments. You know, when you have better room, so those things are not off the table. And I think that's one thing that's important too, is like, you can have risk, but you've got to really understand your risk level compared to everything else. So one thing that Grant talks about a lot is finding like good index funds. So you're basically exposing yourself investment wise for stock investment to kind of everything. You minimize your risk because you're not focused so specifically in one area. In 1999, when the dot-com bubble was bursting, everyone had their money in internet stocks. Well, it took till about now for 20 years for a lot of those tech stocks to get back to where they were, or the tech area as a whole to get back to the same levels. So it's like people who were very heavy in that area, they were worse off. And so the idea, minimizing risk, is finding things that add over time consistently to their growth. Mm-hmm. Index funds, ETFs, they're in broad markets. That's how you can get out of those things. Mm-hmm. And so, what are some other risky investments that you can think of to get out of or kind of help minimize that? Yeah,
because Grant kind of talks about, and ETFs and just the investing into the total stock market and these index funds that are low cost or low fees and stuff is it's at least somewhat new to investing in general. I'm not actually sure that. Do you remember when they were started?
No, ETFs have kind of been within the last generation of investing.
Yeah, definitely within the last generation. But I even think there's one I was looking at on Fidelity the other day that I think it was only like 6 years old or something like that.
Yeah.
So it's just interesting to see that there are always new stuff coming up, but it's just the idea is to lower your risk, where you're making it easy to invest in one fund, but it's diversifying where your investment's actually going. So you don't have to buy X amount of stocks of this. It's kind of doing it for you. So it's just a simplified version of doing it, and that's what Grant talks about. But the kind of the riskier ones too, which I didn't even know people did this until he actually said it, but he's talking about, like, Travis said Bitcoin, but he's talking about investing in artwork or liquor, actually, like wine and whiskey. There's plenty of things people collect, and often with both of those things, age makes them more expensive.
Yeah.
Preserving art, but then wine, I mean, you just always hear people talking about, like, oh, this is a 1600 wine bottle. I'm like, oh, it must be really expensive.
Never gonna drink it because it's so rare.
Triple fermented, but stuff like that. So those would be considered like really risky investments that honestly I didn't even know about. People did until reading this, and I'm sure it's just like a top 1% kind of investment thing. The people that have so much money that they're getting into this stuff. So, but also risky stuff is, let's try to hinder from investing in baseball cards, sport cards, Pokemon cards, which has been something lately, which is crazy. My grandma used to buy Beanie Babies. So there's just weird things like that, or coins, stamps. So there's always a niche market for all these things, but for the most part, Trav and I both invest in the stock market. Mm-hmm. Lately I haven't been investing too much. My wife and I recently bought a house, and then Trav actually recently bought a house too, but so I've just taken a little bit of time to not invest some of that extra income each month, and then also just kind of waiting on the election to finish. And with COVID, I just, right or wrong, I mean, I missed out on some opportunities for sure and went against even my own thoughts of investing to steadily always do it. But just kind of been holding money in cash until things settle down a bit and figure out, what I need and if we want to put some more money into the house, stuff like that. But overall, that's kind of how we've minimized risk, at least recently.
Yeah, and it's still always thinking about how long-term these are going to be. So sometimes you may feel like, oh, you're investing too much in one area, as long as you're realizing you're going to be alternating that. But yeah, like only having your house as an investment, that's a risk because housing market crashes, your area isn't doing as well, or you're just in a stagnant housing area. That's not great. Spending the time right now to focus on the house, that's fine, because when it's a part of a larger investment picture, then it's going to be fine in the long term. So it's kind of not having your eggs in one basket is really what it is. And so then it's just, okay, what's the bigger basket? What's your bigger goal? And, if it is get the house first, get started in the house, then, okay, move on, invest in some of the other areas, then that's great. It's just going to be a part of the larger strategy.
Yeah.
So
the second strategy is minimizing fees, and specifically with investing into the stock market. Trav and I have talked about this a lot, but I think there's just a little bit of a learning curve when you first get into investing. But something you often hear about, whether you're reading financial books, reading blogs, watching YouTube videos, is there ends up being a lot of fees that comes with investing. So just want to encourage you to look at some of the more specifics, but it's not as intimidating as it sounds, both investing and then also looking for the fees. It just takes paying attention. So like for using a financial investor, one, we're not professionals, but we both do it on our own. Trav uses Robinhood, and he can talk about some more specifics about how user-friendly it is, but I just use Vanguard and Fidelity, actually. I have an account with both of them, but you can research all this stuff, and once you feel comfortable and confident enough, you can start investing yourself. For instance, one of the index funds I use for Vanguard recently, at least in the Roth IRA that I've been investing into for both my wife and I, is a total market stock index fund, but it's actually retirement target account. So it's like technically like the 2050, so 2050 goal fund, which I am trying to transition out of just because I realize that's why I've been investing too, because my mindset has changed just because I don't want to wait until I'm 62 to retire. But the fee it's a fraction of a percent. Now, when you use a financial advisor, which we're not necessarily saying don't, but they charge a lot of them fee-based, and there's two routes you can go. There's one, you can just pay a financial advisor perhaps on an hourly basis for them to guide you and help you get in the right spot. I think that's great. It gives you some confidence. Go for it. But the money you end up paying a lot is the AUM, or assets under management. And this is where a company or a broker is charging you a percent of the amount of money that you're invested with them, whether you do good or bad. For the most part, I have heard a couple companies that do it just when you do well, but even if it was a percent, often it's going to be 2%, and it could be higher. But you're investing over 20, 30, 40 years, and then when you are retired and then when you're older, it just ends up being so much money. And we often talk about 1%, getting 1% better, or growing your money to try to get like 4 to 6% in the stock market. Like, we're very conservative with our ideas and numbers, but you can just lose out on a lot on something you just put some initial effort into, and you just feel more confident and safer about your money. So that's the big thing about minimizing fees, is just paying attention and realizing, when and where you're willing to give up a little bit of your money.
Yeah. We can list what chapter it is, I can't remember, but Grant actually shows a calculation of if you had your money invested for a very long time and you're paying even just a 1 to 2% of your assets, but realizing that this investing is all about the 1 to 2%. It's all about increasing your investment a little bit, 1 to 2%. every year. And all of a sudden when you're taking that away, you've totally crippled your investment. And it's just hard to think and see those things now when you are trying to plan for that far ahead, but realizing that that's where it all compounds, is that little bit over time. And so, yeah, you look at in ETFs or a mutual funds, their, kind of expense ratio of like what you're paying for about every $1,000 is kind of what it normally ends up to. But it's a fraction of a percent. So, and that is going to just maximize your money when you're getting, frankly, similar returns to what you could get under actively, managed assets.
Definitely.
And even if you didn't, but one of his facts, and what is great is they've even found that 90% of people who are just picking their own stocks are underperforming the market. So it's like just picking broader stuff anyways is going to get you better than average returns, which is going to make you more than enough money. And that's just what these managers are trying to get, is better than average. And so if you're getting that with barely paying anything, you're going to be better off. You're going to be, and you're going to have more, financial flexibility. It's just getting the knowledge. It's okay to get started, have someone help you get the knowledge to get there, because sometimes people just want to forget about it and just say, grow my money, but then realizing how much you're sacrificing to get there. Yeah. So the little things matter. Don't fret about it though. Learn about it. It's never too late, Yeah. So it's just learn about it, and then, just slowly, gradually get yourself to a better, more, managed place.
Totally.
The third simple strategy for maximizing your investments is minimizing your taxes on your contributions. So this is really, this is trying to maximize and not give all your money to the state. There's great vehicles to help you build your wealth for what you want. And one of the most common, the things that we use, and I think actually one of the most effectives, are 401ks. So these are investment vehicles that typically your company provides, and then they give you a tax advantage because they choose at what point you're actually contributing, at what level it's taxed. And so you can kind of strategize to figure out when you want your taxes to be taken out. And so the two main versions are, you can give pre-tax or post-tax dollars to your 401k investment amount. And so that's going to say either after your taxes are all taken out, you're going to invest money, and then when you withdraw on it, it comes out tax-free. So that typically is strategized for when you think you're going to make more money in the future and your tax bracket would be higher.
Yeah.
So that's important. Or that's typically a Roth IRA, which stands for individual retirement account. And yes, no,
IRA.
Yeah.
I'm not sure what the Roth stands for.
The Roth was the guy who created it.
Okay.
Yeah.
Keep it up.
So then a 401k was the typical, kind of offered through your company investment amount, where you're giving pre-tax dollars. So what that does is you're actually getting taxed after that money leaves and goes into a retirement account, and it can actually lower your taxable income. So that's actually one of the benefits right there, is you're lowering what your tax bracket could be. And then when you take out your money later on, you're going to be taxed on it when you pull it out. But the idea is, if you're in retirement, then you're going to be making less money or need less money to live, because your expenses will be lower, have the house paid off, stuff like that. So you'd be in a lower tax bracket, take out the taxes when you're lower. So it's kind of tough to kind of think about where you're going to be. I think that's the whole point of what we want to do, though, is think about the life, the finances that we want to create to get there. So you don't have to have it all figured out, but that's one way to do.
Yeah, I agree. I personally don't have a 401k right now. I invest into a Roth IRA, but it's one I created on my own through Vanguard, like I was saying. Just because currently I don't have access to a company retirement account. I should soon. I think it's just in the works. So hopefully soon, and I can give you guys an update hopefully with that. But I'll for sure do it, because I want to lower my taxable income as long as I can invest it. And you just might as well, because companies usually match it. So you're automatically getting return on your investment with a 401k match, and it's usually a percentage of up to a certain dollar amount, depending on the company policy. But regardless, you're making money just by putting aside your own money, and you can do it automatically each paycheck, so you don't even see it. So definitely recommend that. Maybe in the future we could also talk about the HSA. Maybe not today, but I think I don't have this, but Trav started using an HSA account too, and it lowers his taxable income. But also it just helps with tax benefits in the future. So super cool that. I encourage you to look up that, and we'll try to have some more information on that soon. The fourth strategy is maximizing your returns. The main one for me is just thinking about how just keep your money in the stock market. Keep your money that's invested, and don't pull it out and put it back in and hope to try to time the market. The better idea is just to steadily invest it in small increments over time. That way you're not missing out on any opportunity. But for instance, like when there's a huge drop at the beginning of coronavirus when it first came out, huge drop, but it's already surpassed that amount. But if you took your money out on a couple of those days that had huge gains, then you missed out on opportunities. Or if you just wait, for me, I just stopped investing during that time. I did a little bit in the beginning, but I mean, I missed out huge on the gains that I could have had if I just would have invested in the beginning. So part of it was just fear of not knowing what was going on. But I think it helps relate a little bit to, like, I get it. Like, I understand that it's fearful to invest and because you don't know what's going to happen, but getting the confidence and reading, understanding that it's not as scary as you think, and it's not like gambling. And that is something Grant talked about too, is investing is not gambling unless you're trying to day trade. And that's not what we're encouraging, and that's not what we do. No, I don't have the mentality or stress capability to day trade, and I just don't want to learn about it. So we're not trying to beat the stock market. We're just trying to make sure we're invested so we can increase our money along the way. So that's my thought on basically maximizing returns. What about you?
Yeah, the old saying goes, not timing the market, but time in the market. And so it's definitely one of the most important things, because the stock market is fueled by human emotion. And so if you understand that, then you're going to understand, well, humans typically are going to try and put the short term over the long term.
Yeah.
And so there's going to be the very short term major fluctuations when people are fearful, people are uncertain, and so they make irrational decisions. Yeah. So always keeping that in mind, that helps you maximize it, think for the long term. And yeah, I mean, buying low is a great opportunity. So it's like putting things in over time. Dollar cost averaging is also very important. And so that's how you don't miss out on big returns, is because you're kind of always putting it in. You're not putting all of your money in focusing on one pinpoint. That's kind of putting all your eggs in one basket.
Yeah.
Oh, it's at the low point. Like, I'm going to put everything in, and you realize that wasn't even close to the low. Mm-hmm. So it's just we can't predict anything, and so we don't want to. So that's one of the best ones. But then really kind of the other steps that we've talked about maximizes your returns. When you minimize your risk, you're going to maximize your returns. When you minimize your fees, you're going to maximize your returns. And then to like the 401k, HSA, when companies have matches, that's how you maximize your returns. Even put like whatever if your company has a match, put it in up to that match. It's legitimately free money. They're giving it to you.
Yeah. So,
and HSAs, all that, tax vehicles, they're advantaged. That's how you can maximize your returns. So it's simple. It's just not very easy. And so it still is difficult because you have to control your emotions when you're doing it. But that's why you start small, and that's why you learn over time. Mm-hmm. So that was our simple strategy for successful investments, and kind of some examples of what me and Ryan end up doing. And once again, they're not overly complicated. It's just kind of controlling your emotions, and it's just understanding kind of the steps to doing it. This takes time, but it's not difficult. And so getting to know someone else who's doing it, asking questions, it's the best way to learn, and we're still learning too. And so, yeah, hope that this is beneficial to you.
Yeah. Fun spending time with you guys, and we love talking about finances and money and investing. But yeah, this is not something we just have known. It took us a lot of time, and it's just small incremental steps that you just learn a little bit at a time and slowly just become more confident in understanding what's going on. So feel free to ask us questions. Let us know what you want to hear more of. If there's any books or information that you're interested in, comment below, and then we'll talk to you next time.